Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob. And for people who miss you on your regular show, you'll be featured on This Week in Money this weekend. So you get a double hit.
Yeah, we were looking forward to that one too, and here it is, Friday, and we're together for our little chat.
Now, this Reddit, GameStop, gamers, day traders, Robinhooders versus the big hedge fund managers, have you seen anything like this in the past?
I've seen some crazy markets in the past, but, and even historically, this is amazing because for a moment, new and small traders forced a huge loss on hedge funds which are run by pros. And that is exceptional. But then what wrote a couple of weeks ago was that in New York, the saying is that the public is not allowed to make money in the stock market. And the reason for that is because the public is the stock market, and when it gets in, always at a top, who's left to come and take it higher? And then in Vancouver, it's even more brutal, and that has been that the mooches are not allowed to make money in the market, but the promoters need the mooches in order to offload stock. So we have an extraordinary mania here, but we also had it a few years ago in the what am I trying to think? Yeah, in the blockchain, all that sort of stuff. Bitcoin, that thing was amazing, and then they're up and at it again. So, Jim, what we are in is a period of immense inflation in financial assets. And what you've got going recently is that no matter how reckless the Federal Reserve has been, the street thinks that under the Democrats in administration and in control of Congress, it'll be even more reckless. But it's worth, and also then the street is thinking that they can get back to some the old-fashioned inflation like in the 1970s when hard assets, commodities soared, and you had silver and gold. And now there's a good one. And you talked about it a while ago, Jim, was the Hunt brothers and the huge silver bubble that prevailed in the late 1970s, along with high consumer price inflation. And Hunt brothers were wealthy Texas or Oklahoma oil men, and one of them, Bunker Hunt, got onto the idea that there was a shortage of silver, and at the same time got on the idea that the gold-silver ratio should be about 15, because a few hundred years ago it traded around 15, and 1,000 years ago it might have traded at 10. But so they got engaged, and with their connections in the oil business and Arabs and Saudi and all kinds of things. So the street and the whole world became convinced that gold-silver ratio was going to go to 15. And I think if you check back on the numbers, at the height of the speculation, it did get to 16. And one of the things is that the key then was that silver, and it became hugely priced in real terms, like relative to the CPI or relative to other commodities. And so what happened was that silver came out of the dining room chests, out of attic boxes and all kinds of things all around the world, because individuals, without even having the numbers in front of them, knew that silver was very high priced. So it went into wherever the bid was, and then a lot of it went into being melted and refined for the bullion market. But the main thing is it was a crazed speculation, and it completed its high on January 21st, 1980. So it was one of those January peaks, and then it went into a severe contraction. So, now there's something else with this action lately in silver relative to gold, as we keep track of it, and many do, is the gold-silver ratio. And typically in a financial mania, the gold-silver ratio goes down, and we have been in a financial mania, and so the way I look at it is that the gold-silver ratio should be down, but what happens is that as a highly speculative game is maturing and getting old and long in the tooth, the gold-silver ratio will get volatile. So it's been popping up and down, and of course recently made a new low. So this is in sympathy with the terrific speculation going on in the financial markets. So it looks like we call the gold-silver ratio the metallic credit spread, because in a boom it goes down. So it's like a credit spread between high-grade and low-grade bonds where the spread narrows, and the gold-silver ratio goes down. And so we're watching it here for getting oversold and setting up for the next rally. So, but more specifically, it was the Reddit players and the Robinhood players who were looking for another game to play, and they thought they could do it in silver, but the silver market is way larger than some of these stocks that they've been gaming, so they would run into all kinds of things. Now, Jim, also on the theme where the establishment doesn't allow the public to make money, and if the establishment is on the wrong side of a short squeeze, you'll find that the exchange or officials will do something to ease the problem in favor of those who are, in this case, the establishment is on the wrong side of a short. They will help the establishment. I know of cases decades ago in the Vancouver Stock Exchange where there was a warrant outstanding against, and the company was a pretty good deal, and the promoters had lots of money, and so they thought, what the hell, we'll buy the warrants out of the market and short squeeze them. And that was a stock called RDOB warrants. And I used to know the promoter on that, David Elricks. Anyways, what happened is that the establishment was shorting as the guys that the promoters of the company were buying these warrants. And maybe they might have even shorted more than existed. And then the way the procedure would have been is that there would have been a buy-in date where the floor trader on behalf of the exchange would step in and force the buy-in for the shorts to buy. Of course, they didn't. The warrant was expiring, and they avoided their own rules and regulations. So here, with the silver thing on silver, which would have been an immense struggle because silver is a pretty big liquid market. So what happened here is that the guys at the commodity exchange, CMT or whatever they call it these days, then raised the margin requirements, which then broke the hard speculation in silver. You had some really good spikes up in some of the silver stocks, which was understandable. But my view on this is that the gold-silver ratio itself becoming volatile as a financial market is over-speculated is in itself a warning on how much further the speculation in whatever game can run. So, interesting times, Jim.
Bob, you had an interesting quote connected to this.
Oh, yeah. To figure it out, it's not Reddit science, which is a play on the old one about it's not rocket science. So, yeah, I admire on the buy side, the guys figuring out which stocks were way over-shorted, and then with many, many, many individual players coming in and driving something straight up and inflicting, at least for a while, a big loss upon the establishment. That's it. Jim, I'd say hats off to those guys for doing it, but anything goes straight up comes straight down, no matter what the story is, and then if it involves shorts, the authorities will always rig it so that the guys who are short within the establishment really don't lose too much. But I think there was some terrific embarrassment. There was some shuffling around a huge amount, billions of money to kind of shore up things, and then some of the hedge funds had to sell their longs. So, we were going into a probable domino or cascading effect, and yeah, I loved watching it as it was happening. And the other thing is that it was a crazy mania, definitely culminating in January when such events can culminate. So the stock market itself, the senior indexes, they may have further to go. We're not certain there, but we do know that in the S&P and the Dow that technical excesses have been accomplished when they might be. And then what you look for now is a loss of momentum, which seems to be happening. And then the other step would be taking out the early January lows. We got close to that, but it's not quite there. Even on the broad New York Stock Exchange comp index, it didn't do that. But then now you've got S&P to new highs, but you got the broad index, the New York Stock Exchange comp is not making new highs. You don't know. There could be further up. Then the other thing that has become constructive is that oil and gas side has come into a rally, and I think the rally is due to getting past when there may be a seasonal low, but mainly due to the fact that the new administration in the U.S. is out to destroy the U.S. energy business, and of 80% of U.S. electrical energy relies upon fossil fuels, oil, coal, or natural gas, which is generation of electricity now is really remarkably efficient. So you really have some mad, crazy people in power in Washington, and they are determined to end oil and natural gas production as well as coal. So, and of course there is no offsetting it. So the quip I've had, Jim, is that, of course, this is repeating what is happening in Canada, where the federal government is dedicated to destroying not just the production of oil, but also the pipelines that transport it. And that's been on for a long time. And if you take a look, and I just recently read an article in Reason magazine about the oil business in Venezuela, and less than 20 years ago, Venezuela was very prosperous because it's sitting on an absolutely superb oil reserve, absolutely outstanding. And the magazine, and as we all know, mentioned that Venezuela now can't even distill its own gasoline. They're relying on outside suppliers for gasoline within Venezuela. But this one, the Reason wrote that in the early days when Chavez was running, of course, the business side of the equation in Venezuela would resist him, and the oil companies would, because they know happens when socialists take control of things. So then once with control and I think a certain nationalized oil company, they fired a lot of the top talent and replaced them with political hacks who don't know anything about the oil and gas business. So it ended up destroying the country's economy and their oil business. But it wasn't through a hatred of oil. It was a hatred of top management. Whereas in Canada and the U.S., the shutdown of the oil business is based upon absolute hatred of fossil fuels, and that in turn is based upon the superstition that CO2 causes adverse climates, and as we've discussed for decades, is absolute nonsense. It's going to be interesting to watch. So this is where our call has been, is that oil prices can go up, and but keep in mind that the U.S. and Canadian oil companies won't be allowed to make any money. So the oil price going up would be changing the U.S. from the premier reserve and producer in the world to a have-not. And but I'm hopeful that the determination of the administration in Washington to destroy the economy and to destroy the middle classes may find some opposition within a number of in the states, within the state legislatures. It seems to be that there could be a natural opposition developing to absolute insanity. So, Jim, we are in wild and fantastic markets, and when you think about it, the politics in the U.S. with the naked ambition of the socialists, they're just as wild and crazy as the speculators in the financial markets. So we'll see how it goes.
And you also had an interesting quote from a veteran trader making fun of these Robinhooders, saying, "In all my 6 days of trading, I've never seen anything like this."
Oh, Jim, yeah. That was a fun quote, yeah. Because I can sit here and say, oh, my God, I've been 58 years, or 50, I guess 58, 1963, you figure it out, in the markets, and then also a financial historian, and you know of the great plays in history, and they date back. There were huge mortgage speculations back in the Roman Empire, for gosh sakes, and they reached speculative ecstasies and collapsed, and then the government had to reorganize finances for all the big major players and that sort of stuff. And you also had periods of boom where there were shortages, and then you had periods of contraction. So then the Roman government came out with subsidized mortgage rates for farmers. And then, just like in the 1930s New Deal, the Roman government then insisted that with an excess of wine, it insisted that wine people destroy grapevines. Now, actually, this one is in a book called The New Deal in Old Rome that was published in 1938 by a Pulitzer-winning journalist, and it was then meant to show that what Roosevelt was doing with the New Deal in the 1930s was not too different from what Roman bureaucrats were doing under similar circumstances almost 2,000 years ago. So there's nothing new. So great speculations, when they're on, are incredible. But this one, Jim, with what makes it particularly interesting is the comparison to 1929, which was the last truly great financial bubble. And you have strong residential real estate, or you did have it with it. You have moderate rallies in industrial commodities, which we have because the play is in financial instruments, in where some of the gold bugs are now talking that gold's going to go to 10,000 or 15,000 or something like that. they'd understand that the action in global bond markets, with the yield for the German 10 note getting negative in nominal terms for the first time in history, that's the equivalent of gold going to 30,000 or something like that. So the huge speculation is in the financial markets, and there's no question that the public is in. And this number you can't really find, but to my experience, the market has enjoyed a terrific number of new stock issues, a terrific number of new stock speculators, a terrific number of new accounts, and there's been nothing like it since the late 1960s, when that was then a new issue market. I really enjoyed it because I was on the institutional trading desk of a really strong regional broker in Vancouver, and we had new issues coming out, and they'd double or triple in an instant. So it was absolutely fabulous. And then there was the new issue that didn't work, where everybody wanted to own it, and everybody got felled, and then it died. And that was effectively part of a terrific bull market. So if you take the S&P and deflate it by the Consumer Price Index, I think it had the high in December of 1969, and then by the time you got to the end of that secular bear market, in relative terms, that was in I think the middle of 1982, and in real terms, the Dow or the S&P gave up something more than 60%, so it was a disaster because everybody was playing the inflation items. And what you've got now, let's back up on that one, Jim, say everybody was playing the old 1970s inflation items. And then what we've had since then, and particularly in the last 5 or 6 years, it is huge inflation in financial assets. And what history tells us is that when the inflation in financial assets ends, it doesn't shift over and start inflating commodities. What happens is you then get a serious contraction where essentially all prices deflate. So this is probable, and it's more probable than any of the other alternatives that are being discussed out there, particularly the one that this latest really aggressive steps by the Federal Reserve and by the U.S. Treasury will be inflationary, but I don't think it's going to happen. When this great financial mania rolls over, I think it's going to take everything with it. So as the Chinese say, we do live in interesting times.
We'll have more with Bob Hoye right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, Fed head Jerome Powell says the Fed won't pop this bubble. What does he mean, and what does it mean to us?
Oh, well, yeah, there's at least the headline writer recognized that somebody at the Fed, the head guy, was realizing that it was a bubble. But, of course, the Fed is not going to puncture the bubble, otherwise it's going to get blamed for it. But this is what happened after the 1929 bubble, was that later on, like in the early 60s when macroeconomists became important and they had computers, they then pointed out that the Federal Reserve was a perfect system, but that the Fed was inadvertently tight in 1929, and that caused the crash, and the crash caused the Depression. And this is not true. You can show that the Fed was easy. Sure, it raised the Fed discount rate in August of 1929 to 6%, but that was just following the money market. But also, and then the New York Times editorialized that what the Federal Reserve was doing was tightening a little to Wall Street because it was crazy, but easing to Main Street. So that was the ploy. But that thing was already written down because the Treasury bill rate had peaked in May and June of 1929. And then when the Treasury bill rate started down, it effectively said that the boom was easing. And then it, reached its final high in September, and then you started the contraction. And the New York Fed bought bonds out of the market during the crash, and as a matter of fact, it exceeded its lending authority by a factor of 6 times. And then I've mentioned this many times, that at the worst of that first bear market was in July of 1932, and the prestigious Barron's financial newspaper had an editorial that essentially pointed out that every anti-deflationary measure taken by the Federal Reserve System is seen not to work. And the anti-deflationary measure mentioned in that editorial was the Fed buying bonds out of the market. So the notion that the Fed was deliberately tight and caused the crash, it punctured the bubble, is not sound. And I don't expect the Fed to do anything here that would appear to end the bubble. And what's going to happen is that when all of the players are fully exhausted and with wonderful stories and fully committed to the long side, and all of the shorts have been squeezed and destroyed, then it'll roll over, and then you'll go into contraction. So I'm watching it as not just a skeptic, but also as an historian, and familiar with what the game was in 1929, and also the previous bubble in 1873, and this, Jim, could be pertinent to today, was the U.S. was between central banks. So they had sometimes they called it the Treasury system, sometimes they called it the national banking system. But at the time, and the bubble was going crazy in the summer of 1873, strains were appearing in the credit markets, and the then New York Herald editorialized that nothing could go wrong. And the reason why nothing could go wrong was because the United States did not have a central bank. They had the Treasury, and the Treasury was there to buy bonds out of the market and prevent a contraction. And there is evidence that the Treasury did buy bonds out of the market in the troubles of 1873, but the contraction came in nevertheless. And in England, the persistently weak economy prevailed, and it was the senior economy then, and leading economists in 1884 began calling it the Great Depression. And it lasted until the washout of 1895. So we've seen this before, where the U.S. was on a fiat money system. That means they could print any amount, and the Treasury was prepared to buy any amount of bonds, and the leading newspapers touted that nothing could go wrong because of what the Treasury could do by way of providing emergency liquidity, and it wasn't enough. You went into a well, as they called it then, the Great Depression. So it's going to be fascinating to watch, Jim.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, U.S. construction spending has hit a record high. What does that mean?
Well, there's the boom part. There's certainly the financial boom. But underneath it, there are parts of the economy that are pretty lively. And take a look at lumber price, for example. But then you've got this exceptional thing going on whereby people are leaving the deplorable centers of Democrat cities and getting the hell out into the, call them the suburbs or the rurals or whatever. And with that, there's the bid for property and the rents for property in major cities such as San Francisco are plunging, but rents and property values in pleasanter places are rising. Vancouver's back to being a firm residential market again. And so then also with people moving out of downtowns, they are then buying houses that may not have had much of a bid hitherto. And then they're also renovating, and then also, obviously, contractors are seeing that the demand for housing and homes in more rural areas, they're building. So this is where you've ended up with this tremendous bid for lumber and stuff like that. But, Jim, I think what we're talking about is a weird economy. And what's made it weird is that beginning a year ago, the bureaucrats went crazy and started in March the lockdowns. And that then was the hardest hit to employment in history. So that was exceptional, and it took the financial markets down into a V, boom, and then straight up again. Because underneath it all, I think that without that, can you imagine how this economy would have been booming? And it would have been it would have been going along with the boom in the financial markets. So now, here again on classic big bubbles such as 1929, the moment the financial speculation ended, so did the economy. Because the bubble, financial asset bubble, it dominates everything. So, for example, you had otherwise outside of a financial bubble, the stock market peak usually leads the economy by 10 to 12 months. And indeed, the economists have put together what they call the leading indicators on the economy, and the S&P in there gets a good weighting. But if you take a look at the stock market in New York in 1929, the stock market peaked in early September, and then after the event, the National Bureau of Economic Research, the NBER, which is the sort of semi-official body that determines the business cycle, they declared that the recession started, or the economy peaked in August, stock market September, and then you went into the Great Depression. Now then, also the NBER years ago did recreate the business cycle back to, I think, 1857, but certainly they got it by months of the peak in 1873, And again, in New York then, the stock bubble peaked in September, and the economy peaked in that October. So this is what was going to happen here. No matter how much the hysterical government screwed things up with forcing unemployment, you still have the natural boom in here, both in stocks and in the economy. So whenever the stock market rolls over, I think you'll find the economy heading south rather quickly with it. So, yeah. And then at some point in heaven, the shorts will be rewarded. Sorry for laughing, but actually in the final gasp of a really huge speculative market, you've got professional shorts out there, which I admire. But if you're short too early, it's going to get costly, so you keep covering. So then what happens is that shorts too early end up being the bid at the top. So then if it's really a huge spike like we've been in, there's been a lot of professional shorts taken out of the market. So what that means is sometime in the future, in a declining stock market, when the professional shorts would be inclined to cover, well, those bids won't be there, which is one of those ironies. So then, and the problem after the great bubble always is that there's no liquidity, because who wants to buy, paper that's heading south? So, yep. Anyways.
Bob, thank you so much for chatting with us.
Yeah, Jim, and we will look forward to talking to you next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, and he loves to answer them, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.